Hi, it's Darren, and welcome to our spring 2022 review. Trying some new software again, so please let me know if you like this format. We're going to cover a number of graphs and slides today where I want to take you through some of the data I look at, give you a bit more insight than what you may just see on television. So why don't we begin where you probably want me to begin, which is what the heck happened? This year has been terrible. We're in correction territory. I'm tired of riding the roller coaster. And of course, my job, as you know, is to remind you to keep your head and arms inside the ride at all times. The graphics kind of fun. The cartoon's kind of fun. One thing I want you to note, though, is when they drew it, which was 2015. So it's almost 7 years ago. So thus it ever was and ever shall be. There's no getting around the fact that volatility is a feature, not a bug of how investments and investing works. But we never seem to be out of it. We're in a correction right now for sure. It's interesting when we look at markets and things across the world. Toronto is down about 5%. By the way, these numbers are as of Friday the 13th, May 13th, 2022. So year to date, Canada's down about 5.3. We've actually been held up because our energy stocks are doing well. We'll talk about that in a minute. First time in a very long time, actually, really, that energy stocks are coming back. The Dow Jones is down 11%. The S&P 500 is off about 16. I've talked in the past about how overweight the S&P 500 was to technology stocks, so that's part of why it's accelerated down a little more than the Dow. You can see the NASDAQ, which is the technology-heavy index, is down 25%, and even Europe's down 13.8%. One of the things that's also interesting is how some of the former market darlings, the favorites, they're off quite a lot. So Tesla is down about 27%, Amazon 32%, Alphabet or Google is down about 19%. Meta or Facebook's down about 40, and certainly the cryptocurrencies, they're almost half price just in the last 5 months. It's not only isolated to technology. I'd say that this move downwards that we've seen this year has come pretty much across the board. I just picked a couple of other companies just to give you a sense of that. So Nike, for example, is off about a third year to date. So I guess we're all getting prepared to go back to work. So no more sweatpants. But even JP Morgan Chase, one of the big financial institutions, it's down 25%. Couple of points that I'm going to share with you on why that is in a few minutes. But even Garbage, Waste Management Group, or Waste Management Incorporated, it's down 5%. So pretty much across the board, we've seen markets have a good correction. Some sectors, for example, technology, certainly meeting the technical definition of a bear market. One thing to keep in mind, and again, I've talked about this in previous presentations to you, is that the regular intra-year move of the S&P 500 is 14.7%. Even in years where it finishes positively. So we're pretty much almost bang on that right now. So this is a normal movement in a market, actually. But of course, the press will make you think that these are the end times. These are not the end times. And actually, I have some good news for you near the end of this that I want you to focus on. But why don't we also begin with what we should probably be paying the most attention to, the things that are really, I think, driving a lot of what we see. And the first one, obviously, is COVID. So let's have a quick look at where are we with this virus and lockdowns that were really the trigger for a lot of what's happened in economies. Well, the good news, I think, there is that COVID is really kind of moving into our background. Let's cross the fingers that I'm true on that statement. Fatalities and confirmed cases are way, way down. And the world is really kind of coming back from what we saw. So, for example, on this chart, where we look at data around how consumers are operating in the economy, we can see where they were. Let me move my face out of the way a little bit there. So consumer and credit transactions, people spending, it's actually ahead of where it was in 2019. But things like hotel occupancy, going out to restaurants, or people traveling through airports, some of those measurements not quite back to pre-pandemic levels, but certainly vastly improved over where we were just a couple of years ago. So certainly the data says the world is reopening. Let's move on to Ukraine, the other big headline that we've been watching in the last few months. So obviously a horrible humanitarian crisis. I think if there's any good news coming from this, if you could call it that, and it's really that the solution for this is going to be the rest of the world lining up to support Ukraine. And we're seeing that in a variety of ways. We're seeing that in terms of military power as Western countries are bolstering the flanks around Ukraine to try and prevent this from spilling over to other countries. Certainly nobody wants to go in and start a fight with Russia, but really here I think the defense is their best offense. We're also seeing enormous amounts of money coming in humanitarian aid and aid to for military and fix their economy. But clearly, whenever this conflict begins to cool off, we're going to see a huge rebuilding because the humanitarian costs and then the economic cost has been extraordinary for Ukraine. What does it mean for the rest of us? Well, for Russia, it means a terrible time. Their economy, well, they started this, so it's unfortunate for the Russian people, of course, that Putin started this, but their economy is kind of in free fall. We've seen sanctions from so many different industries around the world that this is clearly going to be bad for Russia for quite a long time. From a trade perspective, most of the trade, as you can see here, that was happening between Ukraine and Russia was really Poland, Hungary, Czechoslovakia, not really North America or the West. The trade that we really kind of saw, and I'll show you in a second, is really agriculture and energy. Many companies that have decided to leave the Russian market were like Renault, McDonald's, PepsiCo, Apple, but not enormous parts of their businesses. I'd say McDonald's is probably a larger percent of their business, but they've all been leaving, and and I think you're going to see more, not just suspending operations, but ceasing operations for quite some time. So very bad for Russia, but hey, they started it. The larger impact is more of a secondary one in terms of what it's done to oil and gas prices and also agriculture. And here's an area where Canada certainly can support. Ukraine was Ukraine was one of the largest exporters of wheat globally. So Canada, fortunately, can step in and fix some of that supply issue. But clearly, these are the larger impacts globally. And where does all that go? So with pandemic, Ukraine, and I've talked about this many times, I got bills that are multiplying. Thanks, Johnny. Inflation. It began from not really a problem to maybe it's transitory to it's getting baked in the cake here. And I think we all know this and we're certainly feeling it, but you can see, first of all, inflation is back to where it was 40 years ago. Like the 50-year average for headline CPI is 4%. These are US numbers, by the way. And by the way, I'm using charts and graphs from JP Morgan, the Raymond James Strategy Group, Bank Credit Analyst, and a few other places. And I've tried to source them all for you. But you can see that the average for 50 years, we got used to about 4% inflation. Central bankers say they're trying to get us to. Well, they've kind of flunked that test, if you will, because currently we're at almost 9%. And if you look at where it's really hitting us, food is running about 9%, energy 32%. So very, very strong. So this is where we all, you have to move and drive and things. Although I would also point out that if you're really concerned about climate and you think that carbon taxes are the solution, well, this is what carbon taxes are supposed to do. Dramatically increase the cost of gas at the pump. So you change behavior. So we'll see if these massive increases in energy prices also affect the change that carbon taxes are supposed to do. So we'll see how that unfolds. That's just a little side experiment. But clearly the change, the velocity, the magnitude and the speed of the change has been dramatic. And we can see, for example, the Raymond James Strategy guys put together some of the highlight things. And we all know this if you go to the grocery store, especially if you drive to the grocery store. Gas prices dramatically higher and going to keep going. Food prices up dramatically. And some of these things get baked into other prices. So anything that needs to be shipped by truck, which is everything, higher gas prices increase shipping costs, they increase labor costs. It cascades through the system. And another area you might not be looking at are things like industrial metals. So inflation is no longer, I think, transitory. Some of these may be cresting. We're seeing some data that say maybe some of these, because some of these are related to the supply chain disruptions. Remember, we shut down the world for 2 years and we broke a lot of the supply chain. So some of this is coming from that. So some of those are coming back down again. But in my view, we need to be prepared, I think, as investors and as consumers for higher trendline inflation, period. And we're building all that into our planning software and our processes. And we've talked about that in the past. One very surprising example, and I appreciate Bank Credit Analyst for showing me this chart. If you're looking for a used car right now, first of all, getting a new one's really hard. You probably pretty much have to order it and be patient. But if you need a car in a hurry and you're looking for a used car, it's amazing how expensive they are. So that's an interesting. And by the way, if you have an extra car you're not using it, maybe sell it because you're going to get good money for it. So we're hearing in the press that you take all these factors and others I haven't bothered including in here because there's too many to mention. There's a concern about recession, and that's why markets are dropping and higher interest rates and other factors. Are we going to get a recession? Everybody's really afraid of the R word. And my response to that is everybody just chill out. There's a few other things going on that I think we need to be paying attention to. The first thing is that, remember, stocks, or you should know this, stock prices follow earnings. Corporate profits have been strong. So we can see that they are expected to stay strong. They've been growing at about 5% a year. That looks like it should continue. So that's a positive sign. We're seeing people not wanting to pay as much for those earnings. That's where the higher interest rate concern comes in. So that if we feel, or investors feel, that interest rates are going to rise relatively quickly and more than they may hope, they're just going to go up quite a bit. Well, there's a discounted cash flow mathematic formula that says if interest rates go higher, the value of those earnings in the future changes. So you're not willing to pay as much today for earnings in the future if interest rates are higher. So that's why you see tech stocks being probably the most affected by those interest rate increases. I think it's questionable if we're going to see rates go up as much as people thought. I think the central bankers are trying to be very careful about managing a soft landing. But certainly the market's already decided they're going to take some of the air out of those tires. From my perspective, that's okay. That gives us a chance to buy things at good prices. They were maybe a little overcooked a little while ago, but the underlying businesses are operating okay. Now, I'm also going to show you some US data from JP Morgan here. Very different than Canada, unfortunately, but I get better data out of the US actually. The average American household, I would argue, has probably never been financially as healthy as they are today. Look at their assets to liabilities. Their balance sheets are remarkably strong. And their ability to service debt is also remarkably strong. And I think that's one of the reasons why JP Morgan and some of the US banks, their shares have come down, because they have excess cash in their bank accounts. I'll show you that in a moment. There's about $2.1 trillion, or actually $2.5 trillion of excess savings because of the pandemic. People didn't have to spend as much to go to work or commute or buy food or buy clothes. And also the government pumped an enormous amount of money out into the economy, and many people paid down debt and hung on to it. So with $2.5 trillion of excess savings, look, banks don't like it when you pay off your bills and keep your money. They'd rather the other way. So I think that actually presents an interesting opportunity for the financial sector, because that's actually coming. It's almost the reverse of 2008 when nobody knew who was solvent. Now there's too much money sitting there parked, and a little tricky to spend it, right? Because if you go to buy some stuff today, some of those supply chain disruptions still make it tricky to get what you want, right? So it's not just cars. If you want to put in a pool, you want to buy, there's stuff at Home Depot you can't get, for example. So there's people wanting to spend, but actually a little tricky to spend it. So lots and lots of cash. So consumers have lots of money. So companies are making money. Consumers have lots of money. And their credit is also healthy. It's not like they went and bought it and that's why they're sitting on it. Like, we can look at all the credit indicators, mortgage, credit card, auto, they're also healthy. So the consumer has lots of cash and lots of ability to spend their cash and borrow more. Let's look at labor demand and job openings. Job openings are way up. The economy is recovering. The biggest challenge right now for most businesses is they can't get the staff that they need. And it's also affecting the kind of return to work protocols many companies are having, because the staff are saying, I don't want to go back to work, or I can't affect childcare. And, I got used to working at home. Why do I need to go back? So companies are saying, look, we can't really force anybody to do anything because it's a tight labor market. So you put those factors together, and also wage growth before I go. So unemployment's way down and wage growth is also up. Not as much as inflation for most people. So they're still going to be behind a little bit, but it is still positive. And this comes from the Raymond James strategy desk, when we look at all these other factors, just look at the dashboard here. So the economy is in bull market territory. Earnings are still in bull market territory. Valuations have come back. That's actually very bullish. Corporations, their activity, their mergers and acquisitions, their spending is also very, very bullish. And seasonality, which is a factor that the technicians use, which talks about where are we in the presidential cycle, the interest rate cycle, the annual month-to-month cycle. There's a bunch of data that says actually a lot of these things are positive. So I would argue that it's really tricky to say we're going into a recession when companies are making money, consumers have record amounts of cash, the ability to borrow more, struggling on what to spend it on, and everybody who wants a job has a job, and it's actually not hard to go out and get a new one if you don't like the one you have. Well, how do you get a recession out of this? I don't know. So I don't actually think there's a recession coming unless they raise rates so much and everybody says we're not going to spend, or Russia does something completely crazy. So it's not that we're not without risk. I just think that maybe some of this might be a little overdone. But again, I've always warned you, ignore the financial press. You can't watch BNN unless I'm on it, because those guys, it's always the end times. And where we think we should be allocating, and again, this comes from our strategy guys at head office. So, and we've already been doing this. We've for the first time in my career in 30 years, we've decided to make a pretty good weighting to energy. I think a lot of the conditions that get me out of it for 30 years are reasons for us to start allocating. We've always loved financials, and I think the U.S. financials, because the consumer's been so strong, are quite interesting. Places to maybe not be as invested, or places that were safe havens when everybody was scared, like utilities and consumer staples. But we're following the guidance. And what you should know is I take research from a large number of places, from Raymond James, JP Morgan, Credit Suisse, Bank Credit Analyst, and a whole bunch of others. And usually what I'm looking for, there is some level of consensus. Not everybody's right every day. So we want to just get an overall sense of what do most people that I've learned to listen to kind of think we should be going. And it's better to be mostly right than really wrong. So my advice for you is going to be stay in the kayak. Okay, we don't want to follow. I love picking on our prime minister. We want to stay in the kayak. We're not going to jump in any one direction. And the data behind that supports that answer. So this is a chart that shows you kind of the top categories going back to 2007. And you can freeze this now and watch this all day and see if you can identify any kind of predictable pattern. You can't, by the way. And this is the danger of chasing what was hot, because by the time people usually get into it, most people do exactly what you're not supposed to do. If you look at the bottom of every investment product that exists, there's a standard disclaimer in North America, Canada, and the United States that says past performance is not indicative of future performance. There's a reason it says that, because you can't guess this stuff. And I'm going to give you an example. And just for fun, let's look at emerging market equity. So this is this pink one down here. I just want to show you how hard this is to figure out. So in like 2013, 2014, that was near the bottom. So you probably wouldn't have wanted to buy it because everybody chases returns. You would have said, I don't want to own that stuff. And then 2016, oh, it's kind of mid-pack. Maybe I should keep my eye on it. 2017, holy cow, it shoots the lights out. I got to allocate all my money there. People rush into that, followed by the following year, it's the worst performer. I see this over and over and over again of people chasing the thing that was hot. It doesn't work. So what is also on this graph is just trying to follow an asset allocation model of staying in a little bit of everything all the time. And what we're doing there, and I make this joke, I try to invest like I wish I could play golf, just middle of the fairway. Just, it's not that exciting, but it's kind of the way you want to do things. But it's also not immune from risk. If we look at the year-to-date number, and this chart comes from us from May 9th, it's actually a little worse by now. But even that middle-of-the-road model was still down 12% in US dollar terms year-to-date. So, but then pretty much everything was negative. So let's keep moving here. And we also know historically that staying in and taking your lumps is better than trying to time this. So our guys in the US at the Raymond James Strategy Desk, they went and pulled up some of these. I've seen these charts many, many times. The data just is so consistent that if you try to time getting in and out, if you were really good at it, you know, the average of all trading days over 20 years for the United States was 6.7%. If you were really good and missed the worst days, your return doubled from 6.7 to 14. So good for you if you were amazing at it. Nobody's that good, just so you know. But if you're amazing at it, your return went from 6.5 to 14. But if you missed just the 20 best days, so you're also amazing, but on that side, and your return actually became zero. So you tell me, do you want to just stay in, bumps and otherwise, and get a reasonable return in the middle, or do you want to try and be exceptional and do something nobody's ever done? That's like 20 jump shots in a row from the center court. You can't do that. But very easy to miss 20 best days. So anyway, the data says just stay in and take your lumps. I know it's not fun. I'm like the guy in the ride. Keep your head and arms inside the ride at all times. Okay, so just to wrap this up, I wanted to keep this short because spring is here and summer's coming. So we should be outside doing things, and the world is reopening, right? So COVID-19, it's still with us. I got it a couple of weeks ago. I just was kind of sick for a couple of days. I've had all my shots and boosters, and we'll probably get some more. If you are not vaxxed or choose not to be or can't be, then please be very careful because it is still around. But I think the world now is reopening as opposed to going back to lockdowns. Fingers crossed that's the case. Ukraine's still a horrible situation there. And to be honest, a ceasefire and a peace cannot come soon enough, and the repair process can begin. What is heartening is the fact that the world outside of Russia is kind of aligned for support. So that's a good thing. Inflation is definitely going to be a long-term problem. I think we might have had some of the numbers crest because a lot of them were connected to that massive amount of money that was spent in the last 2 years. I mean, the world spent close to $20 trillion. Obviously, it's going to be inflationary. even if that comes as a surprise to our central bankers. It shouldn't have, but it seems to have. But certainly something I've advocated, and I think what you should know is for 30 years, this has been my primary investment thesis, which is we do not try to protect your dollar. We work very hard to protect what a dollar buys. So a lot of what is coming with inflation is already built into how we invest and how we think about money and how we build portfolios. So I think we're in good shape in that regard. The other thing is stay diversified. We need to be loose. Trying to chase the next hot thing, you can't. Things move wicked fast. My brother lives in Boston, so you got to say wicked every once in a while. They move wicked fast. And as many of you know, my son David's a Division I baseball player, and he's an outfielder. And like, imagine there were 200 balls on the baseball diamond, and they're all coming from any direction at any time. That's what investing today is like, although there's probably more than 200 baseballs. And they can bounce anywhere at any time. Do not try and catch all of them. Some of them will go by us, but that's okay, right? It's better we just stay on the field and keep playing. And something I've mentioned before, and I think I've actually been really pleased, despite markets being down, very few of you are calling me. So I really want you to know how proud I am, actually, of the discipline that you guys are showing. Like, everybody's kind of taking the message that we don't do panic here. We really don't. And again, when I look at the data, when I look at some of the good news, and the fact that I can now go out and buy some things at almost the prices they were at before they printed $20 trillion, this is remarkable. So I think we're in good shape. So anyway, any comments or questions, please reach out to me. Let me know. The team's doing great. Everybody's fine. They're going to start taking their summer vacation shortly. Nick is away right now. Everyone's going to kind of take their turns. We do have our eye open for some new, we'd like to hire another planner or two if I can find some great people. We have a summer intern named Vasily who's starting on Monday. So some more fun stuff happening that I'll keep you in touch with. And Charlie's feeling much better. Charlie had hurt himself, and after quite a lot of physio, he's actually looks like he's back to being almost like a young puppy again. So we'll be back to some walking with Charlie's shortly. So there you go. Thank you very much for your time. As always, any questions or comments, send me a note, send the team a note. We're here to help. Thanks for your continued trust and confidence. Enjoy your day.